private equity controls just 6.5% of the US economy. But here's the shocking truth about what they're really doing to American businesses. Private equity is an investment class where firms raise capital to acquire and manage private companies or take public companies private with the goal of ultimately selling them for a profit. These investments typically require significant capital commitments over several years. Capital for acquisitions comes from outside investors. In the private equity funds, the firms establish and manage, usually supplemented by debt. Some or all of the debt is often placed on the balance sheet of the company being acquired. But here's where it gets concerning. While private equity accounts for only 6.5% of the US economy, it was responsible for 56% of the largest bankruptcies and 11% of all bankruptcies in 2024. These bankruptcies meant about 66,000 people were laid off in 2024 alone. In retail, specifically, private equity has been blamed for driving dozens of major chains into bankruptcy and eliminating hundreds of thousands of jobs. A 2019 study found that 20% of private equity retail takeovers ended in bankruptcy, a rate 10 times higher than for non-private equity firms. Recent data shows PE was responsible for 70% of large bankruptcies in Q1 2025, though there's been a slight overall drop in PE bankruptcies this year. The industry tends to be most popular when stock prices are high and interest rates are low, but the human cost remains significant. So how can you invest carefully in private equity exposure? 1. Publicly traded PE managers and BDCs. You get liquidity and dividends, but with market volatility. 2. Interval funds and listed private credit funds, broader access, but watch fees and limited redemptions. 3. For accredited investors, consider feeder funds or secondaries for shorter durations and diversification. Always read the documents, fees, leverage, lockups, track record, and downside scenarios. Balance the headlines, stay diversified and risk aware.